Welcome to Larkin-Gowan Insights, accountancy and business advice for all, a series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance, with a variety of presenters from across our specialisms. So, let's get on with today's show. Welcome to the third in a series of Autumn Farming Conference special episodes. On the 4th of November, the Larkin-Gowan Autumn Farming Conference took place and featured presentations from a variety of leaders and experts in the sector. In this episode, Bruce Masson speaks to representatives from Allen Boswell. They talk on managing risk, insurance, inheritance tax, furnished holiday lets, and succession planning. The audio on this isn't perfect as it was recorded live in the room on the day, but it still offers some valuable insights for farmers. Enjoy.
I stand, myself and our headline sponsor, and speakers and headline sponsor, Allen Boswell, stand between you and a very tasty lunch. It's not often that tax and other discussions take a bit of a centre stage at a conference. There was a comment earlier about whether any other hidden nasties within the budget statement. I think we've identified most of them so far. I haven't put the ones on the slides about the national insurance rise, but somebody did ask me in the break about what impact that has. I think it was covered at our budget webinar that for an employee who earns £36,000 a year, the national insurance change will lead to an additional tax liability of £936 per employee. I think Gavin gave a good example of it earlier about the machinery dealer saying that they faced a combination of minimum wage and national insurance changes, £500,000 a year. So that was the national insurance side of things. I'll come on to some other taxes later. Capital gains tax. It's obviously changed with effect on the 30th of October, and there was probably much machination amongst lawyers and accountants like myself on the night before about when that actually might take effect. It actually took effect from 1 minute past midnight on the 30th of October. So if you've got a deal done on the morning of the 30th of October, I don't want to burst your bubble, but that's going to be at the old rates. I love the way that they don't use fractions or percentages that are easily calculatable in your head. So we've gone from a 10% and 20% system to aligning to the residential rates that we had previously had. So that's 18% and 24%, the basic rate band, and those in the higher rate band. Business asset disposal relief will actually exist in its current form until the 5th of April 2025 at the 10% rate. That's the first £1 million worth of gains. But I think a lot of us were expecting that relief to go all together. But with it rising to 14% for the following tax year, then 18% the year after that, it effectively aligns itself to just a basic rate relief again. So if the basic rate is going from 10% to 18%, now in 2 years' time, the basic rate is realigned for £1 million of gains on that one. So not overly generous for budding entrepreneurs of the country. This actually came in from the previous government, and the war on landlords seemed to carry on unabated, furnished holiday lets. So the whole system about FHLs comes to an end on the 5th of April 2025. So the main tax advantages are lost. So we had mortgage interest rate relief that was available, capital allowances available on furnishings, and the profit shares for the property owned can be varied annually. More importantly, though, the CGT vote no longer applied. It was regarded as a trade. I think, and so with effect from 6th of April next year, furnished holiday lets will just form part of so-called unearned income or investment income. Those of you who run furnished holiday let businesses will know that they are time-consuming, they are difficult. And the government to turn around and actually carry on the previous government's work and say they're no longer a trade is a bit of a kick in the teeth. I think for a lot of people who run FHL businesses, are we going to see a lot of these businesses actually just convert to assured short-hold tenancies for much less risk, and probably for a lot of people, not much difference in reward. After all, the inheritance tax benefits are going to be absolutely identical if it's no longer a trade. The one thing you do have in your locker, if your business is structured in certain ways, that business asset disposal relief can still apply until the 5th of April, although I dare say that there are probably quite a lot on the market already. So you have to weigh up the differences between getting a discount on the sale value compared to the tax take that may then happen. You can still get holdover relief on the transfer of furnished holidays. Holdover relief is where you give an asset for capital gains tax purposes, but don't actually pay the CGT at the time. You hold over the gift, and the donee inherits the original base cost of that asset. But it is a deferral of capital gains tax, but at least you don't have to pay it at the time. Very handy if an asset wants to be preserved in a family for long-term wealth preservation. And one thing on this is rollover relief from qualifying gains invested in the purchase of furnished toilets. This was incredibly untested territory, really, for those of the businesses that made rollover gains and reinvested them in furnished toilets. And it remains to see whether it will still be tested in future years. There's no indication that the asset will basically fall out of the regime. If you rolled into your furnished toilet, it stays there. There is no anti-forestalling or retrospective legislation that we're aware of that will actually make that asset stop qualifying for that particular relief. Again, rollover relief is just a deferral of capital gains tax. So there could be quite a lot of holiday cottages that have got very, very low base costs compared to their actual value now. And so profits and losses from furnished toilets will be assessed as a rental property business going forward from the 6th of April 2025. Obviously touched on much earlier, the nil rate band, the rates are frozen until 2030, so that's the £325,000. That's been the £325,000 limit has been in place for an awfully long time now, and has really not kept pace with inflation. But more importantly, most people used to think it used to track basically the house price index, and it really hasn't over all that time. The residence nil rate band of £175,000 is still in place as well. I'll come back to that in a minute as to what that might mean. But I think crucially on the IHT, the unused pension funds as well. So not only do we suffering the £1 million limit on the IHT combined APR BPR, but the unused pension funds and death benefits payable persons, they fall into persons' estate with effect from April 2027. Those of you that have done the maths on this one, is that it could be an effective tax rate of 67% on an unused pension fund. So you take the pension fund, you suffer 40% IHT on that pension fund, and then could actually be 45% on top of the balance. So 67%. So I think we have to be very, very careful about how the pension funds are used in the future. There's obviously a lot of furore about the £1 million limit on for farming businesses, but remember, it's not just farming business; it's all businesses subject to this new £1 million thing, and all people who have pension funds will be subject to this. So there is a very big attack from the current government on inheritance tax. As Laurie mentioned earlier, in relation to the query on the biodiversity net gain, land managed under environmental agreement with UK government will qualify for APR with effect from 6th of April 2025 as well. But again, that all forms part of the £1 million. Again, I think there's a question about what is the value of said schemes. I'm not going to ask Abby or Emma for put them on the spot for a valuation on those ones, but they will fall obviously into the £1 million balance. I just touched on the first £1 million on this one. Jeanette made a very good point earlier, is that within a partnership business, if they've got £1 million sat in their partnership capital account, will exclude land from this at the moment, then that, absolutely, that will form part of the combined APR and BPR balance. £1 million, some people sounds like quite a lot, but an average size farm business, that's your working capital and your machinery. So not only is the £1 million look quite bad on paper, it effectively means that will cover, for most businesses, just the working capital in their business, and it's the land, all the land on top will then be subject to the 20%. It's also very, very important to note that the assets have to qualify for relief as well. It's not just 20% of assets, anything on top of it. They still have to qualify for APR or BPR on top of that one. So we spent years talking about things like Balfour Principles, 50-50 trading, trading business versus investment business. So the assets still have to qualify for relief to even get the 20%. So it actually could be, almost worse than you think. A lot of talk about the first thing that cropped up was the saying that means a married couple have got £3 million worth of allowances, saying you've got two £1 million allowances plus a nil rate band plus a resident nil rate band. Well, that's not true, because anything over £2 million, you lose your resident nil rate band. and Gavin made the point very much earlier, is that £325,000 is your personal nil rate band, it's not your business nil rate band. So not only are we have that attack, they're just amalgamating absolutely everything into the mix. So a married couple has 2.65 million pounds worth of reliefs. Unused allowances are not transferable, unlike nil rate bands of inheritance tax between spouses or partners. A lot of commentary. This is why I don't really like to look at social media in the aftermath of the budget, which just says, "Oh, stick your farm into a trust." Those of us who are old enough to remember the last Labour government in 1997, I won't do a show of hands, but I imagine that there was one or two people in this room who've got a 97 or a 98 dated trust when we thought that the last Labour government would remove agricultural property relief. We then spent the last 10 years unwinding them. And in some cases we wish we hadn't, but in most cases I'm delighted to say that it's the right decision. Trusts set up by the same settler before last week will each have the £1 million allowance. The government intends to introduce rules to ensure the allowance is actually, divided between trusts set up by the same settler after the 30th of October. There's a consultation starting early January 2025. It's a little bit, the horse seems to have bolted though, because people actually want to start planning and doing some work now on it. But with the consultation set up for early 2025, it doesn't actually give us, by the time HMRC consultations run their course, if anyone knows about this, they can take months, if not years. So there's actually a very real case that the consultation may not conclude until the legislation actually becomes passed. God forbid that should happen. But just talking about HMRC consultations, often get asked the question, this is not specifically related to inheritance tax, but on the environmental schemes, particularly in B and G, about how they're treated for tax. The answer is we don't know, because HMRC haven't opined yet on it. It was part of their last government's remit that they asked, how should they be taxed? And the thing they came out with is that from next year you get IHT relief, but they haven't actually said what tax they're subject to in the meantime. So Abby and Emma are probably advising clients on B and G. Then they say, go and ask your accountant, and we sort of smile sweetly and say, really sorry, but we haven't got a clue, or worse to that effect. So the trust consultation is not due to next year. So what does this really mean? Well, keep calm, because we are very heavy on rhetoric and ideology at the moment, but we are very light on detail as to what everything may happen. Gavin spoke earlier, and Kath has reiterated the point about the consultations, not the consultation, but the discussions, will say that the CLA, the NFU, and other lobbying bodies are having with the government. That is, we obviously hope that there is a serious rethink on what they are doing. So, and we have to, allow that that the various lobbying bodies and the government do actually listen to this, because this actually could be very, seriously detrimental to the future of UK agriculture. I think the advice on it would be that we have to wait and see how that actually pans out before we actually lurch into any what is basically going to be very much life-changing advisory for any of these businesses. I've seen lots of ideas about how it all can be done on it, but until we actually get further guidance from the government as to what it all might mean, I think the best advice is effectively to sit on our hands and wait for that to come up. I said, act in haste and repent at leisure might well be, an expression that'll be used quite a lot over the next 17 months. In terms of mitigation of inheritance tax, we've always relied upon APR and BPR as our best friends, and probably BPR as the better friend of the two. That's not to say there aren't actually strategies that people have used in the past, and fortunately today we have representatives from Allen Boswell who will come and talk to you about some of the products that basically are available in the market for those of you who want to take out effectively insurance against making very substantial gifts. So I'll pass over to Sally Key.
Good afternoon to you all. I'm Sally Key, Director and Financial Planner at Allen Boswell. I'm joined today by my colleague Mark Ward, Chartered Financial Planner. I do hope not to keep you too long, as I appreciate lunch is due soon. But I'd like to give you just a little bit of background about the group. We are fully independent insurance brokers and financial planners. The company was established in 1982 by Allen Boswell and now employs over 400 members of staff across our offices in the East Anglia region. The financial planning team has over £1 billion assets under management, and our financial planners spend their time advising individuals, business owners, farming families on pensions, trusts, investments, life assurance, and estate planning. So let's begin. Inheritance tax, what's changed? Well, since last week, rather a lot, I think we'd say. At the moment, as Bruce has mentioned, we are light on detail as to exactly what. But let's just have a quick reminder on this complex area of a straightforward how inheritance tax is now calculated. First, we must calculate the total estate value, including property, land, savings, investments, and now, unfortunately, as Bruce mentioned, pensions are going to be caught into the calculation. We then deduct liabilities, mortgages, and any debts. This leaves us with the taxable estate minus any appropriate exemptions that can be claimed. Without labouring the point that's already been made today, on many occasions, you're all aware that business relief and agricultural relief have been given a shared limit of £1 million, and the effective rate on any excess at 20%. As I mentioned to you earlier, pensions have now brought into the scope of the inheritance tax, and no amount is to be relieved. The pension proposals are subject to consultation, and the outcome of the consultation is expected on the 22nd of January 2025. Expected changes are likely to be effective in April 2027.
So, in terms of what can you do to mitigate the inheritance tax, echoing what Bruce said, waiting is definitely the sensible thing to do at the moment. Let's see what comes out. We don't want to make any rash changes. You can make some gifts. So I've got an outline here of those that you can do immediately. I've gone into a bit heavier detail on some because they're going to build into what we get onto later, and that's some of the products that you can start to use. There will be, hopefully, others that might come into the market or that are already in the market and need to be used in a slightly different way. But until we get that detail in January, they are those that we should be waiting on. So you have an annual exemption. You can give away £3,000 each. So that's the individual giving can give away £3,000. If you haven't used it the year before, you can roll over 1 year. So a married couple, for example, could make a gift of £12,000 between them, immediately exempt. This, one of the exemptions, along with the next, can be stacked. So it doesn't impact any other gifts that you make. Wedding gifts depend on the distance of relationship between yourself and the individual that's getting married, again, per person. So a married couple could give their daughter £5,000 each for her wedding, immediately exempt, can be stacked on top of the annual exemption. So you could give £22,000 as a wedding gift, exempt, as long as there's no other gifts. The small gifts is then, it's per person that you're giving it to. So you could do this 20 times. It won't matter as long as it's to 20 different individuals. It can't be stacked like the others can. So it is an own. So if you give your grandchildren all £250, you can't then use your annual exemption on that same grandchild. You've got to take away the £250. Okay. The more complex arena, and this is one where professional advice is really sort of needed, is then lifetime gifts, as the name might imply, gifts made while you're still alive, so not those that are coming on death. Two big categories really that these fall into, and we're back to those 3-letter acronyms that we've been very fond of today: potentially exempt transfers and chargeable lifetime transfers. So the CLTs are much more complex and nuanced. They typically involve trusts. We won't get into the nature of those because they are their own sort of planning vehicle, and you should be speaking to a professional, probably a solicitor, about those. The pets we will talk about. They can be loosely understood to be absolute gifts. So where you know ahead of time who's going to be the beneficiary of that. That doesn't preclude you from using a trust. It just means that that trust must be able to effectively be seen through. So it must name specifically the person who's going to benefit. At time of moving it into the trust, you give up all rights or benefits to that gift. That's the same if you give it to a person or you place it into trust. So, one example, a property. If you give the property away and let's say it's a holiday rental and you continue to enjoy that holiday rental, that's not a pet. You haven't actually given that away. If you pay the new owner for your holiday stay, a market rent that you would usually pay, then it can be a gift. You've given up all right, you're just another person that's renting that space that you previously owned. Pets then are, and this is that 7-year window that we were talking about. If you live 7 years, the pet will have been successful. It's outside of your estate. If you die within the 7 years, then the pet is said to have failed. The degree to which it has failed is down to the individual circumstance. So there is a rate at which the inheritance tax could be applied called a taper relief, and it's lower and lower through these periods, starting 3 years in, but it's a little bit of a red herring because in most cases, in practicality, it doesn't actually apply. And that's because a failed pet, as we'll show in an example later, actually takes first precedence over that 325 nil rate band. So if you've got other assets, it's going to take that nil rate band, even if you were 1 day short of the 7 year, and it's going to kick other assets that were going to use that nil rate band into the 40% rate. So it might well have an effective of 20, but you're not going to get it because it's taken the nil rate band. The other major exemption, and this is one that comes with a lot of grey area, but it's one again that we'll build into in our examples later, and it's called regular payments, but we read it to mean gifts that are made out of your normal income as part of expenditure on a regular basis. Again, grey in the HMRC guidance, doesn't actually say what that means. We typically recommend that people make it a monthly payment because you can make a very clear, understandable argument that it's a regular payment, but it really importantly should not affect your standard of living. So this exemption allows for immediate gifts to be given away from surplus income with no inheritance tax consequence. They should form a pattern, can't be out of capital, and they shouldn't impact, as we say, the standard of living. Any gifts, including the significant ones, like the pets, the regular payments, small, large, anywhere in between, should be kept as a record. That's because your beneficiaries will need to evidence which gifts were not part of your estate to keep the inheritance tax bill down. It's really important to keep that record because it's a vital piece of evidence. Bank statements can be another piece of evidence, but if you've got, well, this was using the annual exemption, it's very clear when probate comes along and you have to pay the inheritance tax to get it, you can evidence to HMRC, or your beneficiaries can, that the bill should be lower than what they think. So what are the common pitfalls people come across when looking at, and this is the theme, isn't it, succession planning? Not updating wills is a really relatively cheap way to make sure that succession happens in the way you want it to, and in a way that's maximizing use of allowances and exemptions. Any major change, the usual death, divorce, birth, marriage, should prompt rethinking about your wills. Change of business partnership, sale of business, anything like this, any significant life event should trigger looking at the wills. It's a really cheap way to potentially mitigate large financial consequences. Neglecting even talking about it. This is more common than perhaps people would think. You know, every business and farms included should have an idea as to how that succession is going to continue. Overlooking tax reliefs, all of those ones that we've just talked about, they're all immediate. There are those that are available on death that if you operate far enough in advance, you might be able to make use of. It's a discussion with a professional to make sure that those are all in place for when that time comes. And the closed book, you know, not actually discussing with those people who you intend to inherit the business what that looks like. How should they approach things? That's something that's quite often, and you know, I think Sally and I could both think of at least a couple of clients who don't want to talk about it with the next generation, and it ends up costing that generation tens, if not hundreds of thousands of pounds, because just there wasn't the plan in place to ensure that smooth transition. That's all the dry stuff. I'll hand back over to Sally for some perhaps more enthusiastic take on what can you do.
I believe now really is the most important time to be engaging with your advisors, with your solicitors, with your accountants, with your financial planners, to navigate your way through this change that has been thrust upon us last week. Arguably the biggest changes we've seen in decades. I must stress, though, that these are merely considerations and not advice at this stage, as you're aware from Bruce and many others, that we are not in possession of the full detail yet. Trusts, you know, will remain useful. A financial planner can assist identifying opportunities here, particularly as it would appear that the business property relief and the agricultural property relief exemption isn't transferable through spouses. So therefore, it's important that you speak to your legal advisors. This leads me on to wills. It's going to be vitally important that your wills are correctly structured to avoid any double taxation or any costly pitfalls. So I'd urge you to speak to your legal advisors at your earliest opportunity and review your wills and see if they are fit for purpose and suitable for the new rules. Gifts and exemptions, this is perhaps going to provoke discussions, as Mark just mentioned, around giving assets away earlier than perhaps you previously had thought, and needing to survive the 7 years, which leads me into insurances. There are a range of insurances which will cover short-term inheritance tax liabilities relating to these gifts, to longer-term policies to cover the full estate-related bill, with proceeds written into trust for the beneficiaries. This will ensure that funds are available when they are needed, and it isn't necessary for a forced sale, spreading the cost through the years and removing the risk of unexpected early death. Pensions, now these are set to sadly be in the scope of inheritance tax too. There could be more opportunities there to utilise them more actively within estate planning, setting up a regular income to cover life assurance premiums from surplus income, reducing the value of an inheritance tax asset to the liability on other assets. In summary, you were previously able to broadly rely on the default outcome, which was APR, BPR and pensions being free from inheritance tax. But if you rely on the default outcome now, it's highly likely that it will result in a liability. So it's so important that you can engage with your advisors now to try and achieve the outcome that you all want. I have a case study next to try and bring to life what Mark was describing earlier with a failed gift. So failed pet, as we have here. So I'm giving an example of Jane, single, 74 years old, already comfortably retired with surplus income. She makes a gift of £325,000 to her nephew, who is the sole intended beneficiary of her will, to enable him to purchase a property. She sadly dies 6 years later with an £800,000 estate remaining, including her house worth £650,000. She's not eligible for the residence nil rate band as she's leaving the estate to her nephew. So you ask, what is the problem? The 325,000 PET has failed and now takes precedence on the nil rate band of 325,000 as Mark described earlier. 800,000 in other assets are subject to inheritance tax of 40%, meaning her nephew must find 320,000 to clear the inheritance tax bill with HMRC before he can obtain probate. Without probate, he can't take ownership of his aunt's property and is unable to rent or sell it without ownership. So, what can we do about it? One solution would be to take out a 7-year life assurance policy for 130,000 attached to the PET, placed into trust absolutely for the nephew's benefit. The premiums would be exempt as they're affordable regular payments, and Jane already had surplus income. 74-year-old in good health, accepted at ordinary rates on a non-smoker basis, could pay between £135 and £150 a month to secure the cover over the 7 years. If she wanted to be belt and braces about the matter, then she could also consider a whole life policy for the remaining £190,000 liability. Now, I appreciate there's quite a bit of maths, quite a bit of narrative to follow here, and it probably seems quite complex. But this is where us as financial planners can come in and help you. We can simplify the complex for you and put a plan in place.
So for those familiar with a whole of life policy, we'll go into an example, but for those that haven't heard of it, it is a type of life insurance that will continue all the way through until the day you die. You can take it out on 2 different bases. The more expensive is a guaranteed basis, and that is that they look at you at your current age. If it's a joint life, which obviously inheritance tax with a married couple is a joint life problem. It's only on second death that it becomes an issue in the first place because spouses are exempt. So you can take a whole of life on a single life, or you can take it on a joint life, second death. Having 2 lives makes it cheaper because they're not gambling on just the one person dying. It is the second of you have to both have passed away for them to pay out. A guaranteed premium will mean that at outset of taking the policy out, that premium will stay the same throughout your entire life. You can do a different type, which is called reviewable, and those are more for when you have a planned schedule of gifts or something, where you know you're going to bring the inheritance tax bill during the first 10 years of which that premium's fixed. Then you would probably look for a reviewable policy because you're not paying for the higher level of cover at outset throughout the period of your life. Why would you? You're going to halve your inheritance tax bill in the first 10 years, for example, by making pets. So let's look at a scenario where whole of life might be part of the solution. Now we've got a farm, circa 3 million, husband and wife. They're both reliant on the income from the farm and not wanting to give away control while they're alive because they've got whichever concerns they might have, but they don't want to relinquish that control. They don't want to make these pets. So very little else in way of liquid assets, enough really in those assets to cover the funeral expenses, which is an allowable expense for inheritance tax. It comes off the estate value. So just neutral. The only thing of any consequences is this farm, which obviously includes the farmhouse. Modest monthly surplus income derived from the farm, and their wills leave everything to each other on first death, then their 2 adult children on second, because they plan on running the farm together. A fairly typical setup. With no plan, under the proposed rules, and they might well change as we know, but that's one of the benefits of a life insurance policy. It's not a permanent, irreversible decision. You can just stop paying the premium and cancel the policy. It's a solution that's in place but can be altered, not like placing the farm into trust, irreversible. Those sort of irreversible decisions may be taking out a particular type of investment product which has high entry charges. We're saying hold off on those for now. Life insurance is not that. if it's not needed in 5 years' time, you just cancel the policy. So no plan under the proposed rules. They would benefit from £1 million of APR and that 650,000 of joint nil rate band, because the nil rate band of 325 will be inheritable. Their 3 million means that their estate is valued above the 2.7, at which they lose all entitlement to the residence nil rate band because it's tapered away. It goes away once you go above a £2 million estate, you start to lose it. So they've lost it entirely. They have this 1.65 of exemptions. Inheritance tax liability on the second death, 20%, because everything we're assuming is going to qualify within the APR. As Bruce said, we've got the million and then 20% on the excess, 270,000. The children, the 2 adult children who are going to run the farm together, have no means to pay this inheritance tax bill, and they need to obviously secure ownership of the farm to even begin to start to release any parcel to pay the inheritance tax bill. They're probably going to need to find some lender which would lend at, no doubt, an extortionate rate. We were just talking on the drive here. We think these are products that banks are probably going to start to supply more of after these changes are shaken out, because it used to be more of a thing that they would do probate lending. Probably going to see a resurgence. Solution, what do? Obviously, they talk to their solicitor about restructuring the wills, because a legislation change is as big a change as any, or the life circumstantial changes. It's a reason to revisit the wills and maybe consider, if the rules are as they seem to be, are going to be, 1/3 of the farm goes to the next generation on first death to utilise that £1 million of APR that otherwise wouldn't be passed from husband to wife. The survivor keeps 2/3, they leave that on their second death. That's obviously a matter for you to discuss with a solicitor rather than a financial advisor, and that seems to be a sensible approach if the rules don't change, but they hopefully will. We keep our fingers crossed for that. Then the inheritance tax liability has now been significantly reduced and could be as low as only £70,000. So a whole of life policy for a couple 65, all the usual stuff, good health, non-smoking, etc., actually could start from as little as £107 a month. And that is that guaranteed premium that I talked about, which is the more expensive of the two, because it will not increase throughout your life. £107, obviously not a trivial amount, but hopefully affordable from that surplus income. And where are the children going to find the £70,000? They don't need to worry about that anymore. And obviously this is written into trust, so it's not part of the estate. It comes out on second death and goes to those 2 adult children. It means that worry around liquidity, when the funds are going to be available, that risk that you are the ones that die earlier than your life expectancy, you've removed all of that. There is no need to worry, that the succession is in place and it can pass seamlessly to the next generation.
Does anyone have any questions for Bruce or
for Alan Boswell? I'm at an age where I can start to draw my pension, but haven't yet. Should I start to draw now to avoid tax on death?
I would probably wait until the outcome of the consultation in January. Mark, would you agree?
Yes. Yeah, just wait. There is no immediate need, and if we're talking income tax years, you've still got all the way through to the 5th of April to make any sort of withdrawal, and it would be taxed the same as if you made that withdrawal now, obviously subject to reclaiming any overpayment of tax.
Does the beneficiary of a gift need to know the asset has been gifted?
Come on, Bruce.
This is a more common question.
I'll probably defer to my legal colleagues, but if you're gifting into a trust for minors, then I think technically they don't need to know. If you're gifting to an adult, so somebody over the age of 18, they would definitely have to know, because if you're applying CGT holdover relief, both the transferor and the transferee have to sign the form. So unless they're basically blindfolded and asked to sign, then I guess they would know about what's being transferred.
Can agricultural land be gifted and utilise the 7-year rule?
Absolutely. Same thing I just referred to, whether it's been done either as a CGT holdover relief. There was actually a bit about a failed pet. I think we just covered what a pet is in the talk. And they said that if it's a failed pet, then it will be subject, if it's after the 6th of April 2026, then it will fall into that regime. So it would be subject to IHT probably at the 50% and the 20% rate effective.
Any other questions? Great, thank you. Thanks both. So, thank you. Thank you to you too. Hope you found today's sessions useful. There is an opportunity to provide feedback at the end. So the poll, sustainability and ESG, do you consider it as an additional layer of red tape, reporting with limited monetary returns and costs, or a growth market to monetize with the additional requirements being a necessary step to achieve return? Oh, it's quite close, that one, isn't it? Yeah, interesting. It would be interesting to see who answered what there. There's lots going on in the industry at the moment, and last week's budget has understandably worried and angered many, but we are a resilient industry, so we will get through this. We at the CLA are working, like I said, with other organisations. We're working really hard and we'll continue to lobby on the APR and BPR points to ensure that the government's aware of the economic harm. We obviously concentrated on those because they're front and centre at the moment, but there's a huge amount of work going on other topics as well. EPCs, renters, I was going to say renters reform, it's now renters rights bill, planning, compulsory purchase, public access, rural crime. If any of those topics you want to talk about, or anything else to do with land use, diversification, rural economy, then please come and talk to me or one of the team. Please, could I ask you again to fill in the form on the CLA website? You don't have to be a CLA member. We need to get as many names on those letters to write to Labour MPs. We know that there are some local MPs in East Anglia who've been sceptical and quite loud about the perceived benefits of scrapping APR and BPR. So it's important that we explain the issues to them. Please go along to surgeries, invite MPs out to farm. There's been some messages that I've been getting this morning there's been some discussion around mass protests. Understandably, people are angry, but at the moment, I don't think that that's necessarily going to get us anywhere. I think that we need to make sure that we're in the room, that we're having those really structured conversations. Things may happen further down the line, but right now, I think we've got to concentrate on making sure that we can have really good arguments and that we provide the evidence and that we keep that dialogue open, because we are in the room. And we all need, the industry needs to remain in the room. The CLA provides free advice to members. There's a huge amount of information on the website. There's guidance notes on all kinds of topics. Please utilise that. Please call up the regional office and ask the questions that are impacting your business, whether it's on this or whether it's on something else. If you know of any landowners, farmers feeling especially vulnerable in these times, please reach out to them. And if necessary, pass them on to one of the fantastic mental health charities that are supporting our industry. Profits from today are donated to the RABI and YANA, whose role will be more important than ever. You are able to make additional donations by following the link in the brochure. Thank you to all the team at Larkin Gowan, the business development team and the events team for organising today, and to all the sponsors, to Boswell Group, to Ashton's, to Virgin Money. Thanks to Anglia Pharma as the media partner. I'll pass over to Bruce.
Thank you for joining us for Larkin Gowan Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website larking-gowan.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.